Hello, everybody, and welcome to the latest installment of GoDocs webinar series, highlighting how we like to partner with our customers to tackle challenges and uncover new opportunities in the commercial lending market together. My name is Andrew Pearsons, and I will be the co-leading today's discussion, along with my friend and colleague, Ren Hayhurst. Ren, are you as fired up for today as I am?
I'm pretty fired up, yeah, but I usually am about everything, so it's good to be with everybody.
There you go. Yeah, I think today's topic is top of mind for just about everybody in the commercial lending space. That topic obviously is navigating loan modification and demand. I guess before we dive into things though, Ren, maybe go back a couple slides. I'd like to remind everybody that you can submit questions throughout today's session using the Q&A feature that should be at the bottom of your screen. So feel free to add questions as we go through. We have some time at the end to go through those questions and answer them, but feel free to put them in as we're going through the materials. So really looking forward to getting started, everybody. Again, this feels very top of mind, very, very timely, given the response we've seen to this webinar. But I think I'd mostly like to start off, and Ren, maybe just go back to the intro slides real fast. By letting Ren introduce himself, he's one of our many subject matter experts we have here at GoDocs. I think you'll find that his background is very pertinent to today's conversation. So Ren, why don't you go ahead and do a quick introduction for yourself?
Great. So I know many of you out there, and it's great to be with you in these opportunities. I spent 30 years at a large international law firm, Bryan Cave Leighton Paisner, where my practice focused exclusively on commercial finance, first as a trial attorney, and then as a transactional attorney. My primary clients were banks, but I did represent a number of credit unions and private lenders. And it's that experience that informs my thinking as I work with GoDocs and our teams to try to expand our platform, make it more nuanced, more sophisticated, and get a chance to really provide something unique in the market.
Yeah, great. Thank you so much, Ren. And as you can see, I'm the president and chief revenue officer here at GoDocs. I've spent a lot of time over the past several months reaching out to our existing customers, talking to prospective customers, and loan modifications is definitely a topic that comes up a lot. So looking forward to today's conversation. And by the way, if I haven't had the opportunity to speak to anybody who's on this call today, I'm sure you'll hear from me soon. So look forward to setting something up. So as I mentioned earlier, commercial loan maturities, and maybe more to the point, the risk of default has really captured the media's attention over the past several weeks and months. I would say it's actually become so ubiquitous that I was at a family event a few weeks ago where my 80-year-old aunt cornered me and started peppering me with questions about the commercial lending, commercial real estate market, which is probably the first time that I was that popular at a family event. So it was nice to see that happen for a little while. But, again, I think this really has entered the zeitgeist. And so it's not just top of mind for everybody on this call, but it really seems to be something that's really entering the broader conversation. I think a lot of that conversation revolves around the fact that there's trouble ahead. And as we kind of saw what was happening as the Fed was raising interest rates, thinking about the amount of commercial loans that are going to be coming due over the next several years, we at GoDocs really took a step back and said, how can we help our customers get ahead of this? And how can we build a solution for them that is both automated as well as provides the same level of compliance we provide through our other solutions to help everybody kind of weather the storm that's coming. One of the things I'll call out on this slide in terms of the data is that I think it's critical to note that while 2023, 2024, and 2025, you see some really big numbers there. This is not a problem that's going to go away. I also think that a lot of times we hear about this being specific to office space, perhaps even retail space. Both have kind of faced a double whammy of the rising interest rates, as well as a lack of demand as COVID impact has hit retail, COVID impact has hit the use of offices. But what I think is really important to note here as well is that it's not just office and retail space, it's in fact multifamily commercial loans as well that are arguably the biggest chunk of what's going to come due in 2024, 2025, and beyond. Ren, anything else you would add as you kind of look at the data on this slide?
Yeah, I do think it's notable that if you notice that the multifamily hovers anywhere from that $200 billion to $300 billion mark for the next decade. So there's a lot of debt that's going to be maturity. There are opportunities for refinancing and such, but in the market we're in today, everybody's playing it very close to the vest and nobody's really willing to go and put their money out for too long of a period of time.
Perfect. Great, Ren. And maybe moving to the next slide, I don't want to be overly doom and gloom and apocalyptic here, but I do think that, again, it's safe to say that there is a tsunami of commercial real estate loans coming due. They're going to require some level of modification in the next several months and years. And again, I would say that while you all probably saw this coming, we saw it coming too, in many ways through the help of conversations we were having with our customers. And I think it's important for all of us to keep top of mind the fact that it is both the volume of these commercial loans that are going to require modifications, as well as the speed at which we're all going to need to act in this relatively uncertain environment, that really prompted us to think that GoDocs is purpose-built to help you navigate this tsunami and frankly, work with you all to provide you some level of safe harbor in what is going to be kind of a stormy environment over the next several months or several years. But we do want to be partners with you and help you kind of navigate that so we can land this together. Maybe go to the next slide, Ren. Really, I'm going to hand it over to Ren in a second. I think the last point I'll make before Ren kind of dives into the details here is we have been really thoughtful about what the market needs. So as we think about what we call our loan modification solution, ModDocs, as we think about what we offer in ModDocs, a lot of this goes back to not only what we're seeing in the market, but what we're hearing from our customers in terms of the types of modifications that are most common for them and the types of modifications that are frankly creating some stress on themselves, their attorney teams, anybody else who's been supporting them with those modifications, because again, that volume and that speed is starting to pick up so dramatically. So with that, Ren, I will hand it over to you to explain a little bit more about what the GoDocs ModDocs offering is.
Great, thank you, Andrew. So we're going to really talk about a number of factors today. We're going to talk about the different types of ways to work through debt, either as it's maturing or as you have distressed assets or underperforming assets, and helping get those back to in some semblance of performance for both the success of the lender as well as the success for the borrower. So we will talk about things like modification agreements, loan assumptions, whether or not they also include loan modifications. We'll talk about some distressed asset tools, things like default letters, pre-negotiation letters, forbearance agreements. And then we'll even spend a little time here up front talking about a built-in type of modification, the built-in extension option. We're also going to highlight for these different types of solutions, common situations that we're seeing in the market. And one thing I want to lead off on is that when Andrew talks about us taking a step back and really considering what we're facing in the market and what our customers need, historically, when I was a lawyer, one of the very common and sometimes difficult things to explain to my clients was that very often modifications were costing close to, or maybe even in certain cases more, than the original cost of the loan documentation. Our legal fees were pretty high for both originations and for modifications and other reworkings of loans. And I think even as soon as 2+ years ago here at GoDocs, we were seeing some of the same things with our pricing, and we knew we needed an option that was rapid, meaning you would not have to wait for input from third parties. You could use the system and it would be complex and sophisticated enough to give you a whole range of options to deal with these issues, but also be able to do it at a much, much reduced cost. So I want you to keep that in your mind, that is for us, being able to provide many automated options to create highly complex documents in this area is really what drives our thinking. So I'm going to have a series of scenarios, and they're based on real circumstances that we're dealing with on a regular basis, and that helps us increase the way we do business, the way we try to consult with our customers, the way we interact, and the way we respond to what the market and the customers are saying. So as I mentioned, the last thing that I talked about were these built-in extensions. These are opportunities for lenders to go ahead and create a series of terms and conditions. It could be completely discretionary at the lender, for the lender, if they're going to grant 1 or 2 or maybe more extensions of the debt. There might be opportunities to create conditions like monitoring the financial health of the asset, of the secondary support, meaning guarantors, and also to look at market conditions. So built-in extensions can become very elaborate, very helpful tools. And we've noticed a number of our clients who have gone into the last 3 years or so looking at rising interest rates, realizing that they don't know what the market's going to be, so they don't necessarily want to commit to 5 or 10 years on a piece of property. And likewise, borrowers with interest rates sitting in the 6, 7, 8, 9% interest range, they were not willing to really go out for a long period of time. So we have seen a lot of short-term money, bridge loans, interest only, 6 months. But even during these last couple of years where these loans have picked up with huge volume, we've even noticed that these lenders were getting at the end of 6 months and they wanted to kick the can down the road with the borrower. So the use of a built-in extension provides a very efficient way to A, keep your costs down, B, not have to redocument the loan because you've put your underwriting conditions to grant or withhold that right to extend the term of the loan for 3 months, 6 months, whatever time period you're looking at. And it gives the lender a chance to have control, predictability, but not be overcommitted. And those are things I want you to think about as we're talking, because we want to provide tools that give lenders choices down the road that allow them to have predictability and control without being stuck in a negative situation. And here's just an example of a couple of tools within our ModDocs platform. You can choose multiple extensions, how long the extension period is going to be, the economic terms, and add any special and additional extension conditions. You know, Andrew, another thing that we have seen that has been pretty common is we have a number of large national construction lenders who are doing new construction for a variety of projects. Some of those are infill single family residents, some are tract development, some have been apartments, and even retail and commercial. But what has kind of characterized all these loans made in the last, I'd say 18 to 24 months is that for a variety of circumstances outside of borrowers and developers' control, they're facing things like unusual increases in cost of materials, as well as delays caused by supply chain issues. Well, what that does, it creates a situation where very quickly a construction loan that was clicking along on budget and on time can get derailed on both time and expense. And in those situations, a construction lender has a choice. They could, of course, shut down the whole project, but then you've got a half-completed property. It may not have any real economic viability without completion, but you may need to retool the budget. You may have to give additional time, and even in certain circumstances, require additional borrower's funds to be pledged. So we are starting to see a real flow here in the last 6+ months of these construction lenders going in and extending the debt, reworking it, perhaps doing a rate reset. Very often they'll have a new budget and new time schedule, project schedule. So this is an opportunity as a construction lender to see those issues early. Again, I'm going to emphasize control. Take control of your future. Go to your borrower early and start to work on what are we going to need to get this non-performing or potentially non-performing construction loan to completion within a budget that makes sense. So of course, we through ModDocs can do extensions and modifications for all types of our construction loan products, whether that's a construction that had a term period added or a bridge period, straight construction loan, or a revolving line of credit. A lot of flexibility. One of the things that is just part and parcel of having a portfolio of loans, and if you're a private lender that holds a portfolio, or a bank or a credit union that make most of your loans and hold them as portfolio assets, if your debt is longer than a couple of years, if it's 3, 5, 10 years, and you're midway on that chart that Andrew showed you with the debt that's going to come due over the next decade, you're going to have life happen to your borrower parties, your guarantor parties, and being able to very rapidly go in and respond to these issues without losing time or money is critical. We've seen a lot lately for portfolio lenders who have gotten into 10-year loans, let's say in 2017 through 2019. So they've got a long tail still left on that deal. They're facing situations where perhaps a guarantor goes bankrupt or a guarantor passes away, unfortunately, or their borrower at the time was a group of individuals who now want some asset protection, and so they're going to form an LLC, and they need that LLC to step in, become the borrower, and maybe they assume roles as guarantors. So addressing these loan party issues, to be able to go in and in 15 minutes construct a modification that allows you to replace a party, allows you to substitute a party, or create a different borrower structure with the same existing parties is really critical. And it can take a long time if you do it the traditional by lawyer method, or it can be very rapid and very cost effective if you do it through an automated option. So this is something that if you, and I know everybody on this call, they pay very close attention to those portfolios. Again, you want to be able to act early, and you want to be able to act with predictability and protection. One thing, and I've spoken on this subject a good many times over the years, and that is I always look at whether it's an economic force that is causing a lender to consider reworking some of the terms of the loan, whether it is a change in party situation like I just described, or any other factors that require an asset, a loan, to have the deal terms modified, updated. This is a chance also for a lender to shore up their position, to do a loan tune-up, to be able to go in there and do some new due diligence, to look at the strength of the underlying collateral property, review the financial strengths of the sponsors of the borrower, as well as guarantor parties. In addition, I know that there are some automated programs out there that have a very simple 1 or 2 page change in use agreement. And I think historically, people have thought that that was a pretty good way to go. What we're finding, however, is when you have real estate collateral, you're making, in almost all instances, first lien priority loans. It's important for you to maintain that lien priority because that is going to be your primary source of recovery, is realizing on that asset. And so really what you're hearing in the industry, whether it's from lawyers or legislators, that if you're going to rework the terms of a loan, you should not do that in a casual or relaxed manner. You do need the discipline of a couple of things. You'll want to make sure that you have a modification agreement with your business terms that is not recorded on the public record. You don't want your business out there for everybody to see. However, you will want a short form of a deed of trust or mortgage amendment so that you can get the title insurance protection to give you an assurance that you maintain that lien priority that you started with. In addition, you'll want updated borrowing authorizations if you're making changes to the payment structure. So maybe the prepayment is going to be, not the prepayment, the balloon payment at the end is going to be changed. You would want to be safe and have a waiver disclosure under state law for balloon payment. Same with if you're changing things in a prepayment provision, you may need to get updated disclosures and waivers related to those changes in the deal. With the platform that GoDocs has created, if you're making those kinds of qualitative decisions, the system actually knows what you'll need to make sure you're compliant in the jurisdiction where your collateral property is. So you don't have to go through and think, gosh, should I get that waiver? Should I make an updated disclosure? The system actually, as designed by the legal department here in GoDocs, anticipates that, creates those ancillary materials, updates items such as the borrowing authorization. In addition, this is also a chance for you as a lender, if you are making accommodation for your borrower to help them get through a tough period or to help them extend their debt to a point where hopefully it can be refinanced or sold as an exit strategy for the parties. In that case, you'll want to get some basic legal protections. You'll want to make sure if you're getting these accommodations that your borrower is not harboring any potential claims. So you'll want a partial release. You'll want all of your covenants, your reps and warranties to be brought fresh and be brought forward in time as of the date that you're working on this accommodation. These should be part and parcel of what you think about when you're thinking about, am I going to do a modification? What are some of the things that I should be reminding myself of? These provisions are worth their weight in gold down the road if for some reason the situation continues to deteriorate and you may have to look at exercising any remedies. You'll want to be updated on these key legal issues that are part and parcel of your relationship as a lender with your borrower. And then finally, I want to spend a few moments here talking about distressed assets. I grew up, as some of you who know me may remember, I grew up in the mountains of California. And then I lived in Orange County for a bunch of years, but 2 years ago, I've moved up high in the mountains here in Utah. And growing up as kind of a mountain boy, the one thing that really could freeze everybody in their tracks is a forest fire, of course. And so where I live now, it's the big mountain with people spread out all over the place, but we have an early warning system. We have an alarm system, and the first Saturday of every month, these huge horns blast out across the mountain saying, this is a test of our emergency fire warning system. And the reason I bring that up is, if you are looking at a situation where your borrower starts to get shaky, maybe the property's not cash flowing, maybe the guarantors are having other serious financial problems. When you get into that distress, you want to make sure that you have documents that give you tools, that give you reasons to go back to the borrower and have a conversation, whether it's a right of reappraisal, whether it's the ability to seek additional financial reporting. You as a lender want to make sure that before the fire is on top of you and before the horns even go off, you're seeing those wisps of smoke off in the distance and you have tools to act. So I always suggest that once you as a lender start to hear of potential issues, go back to your loan documents. If you use GoDocs, you'll find that you have a lot of interim tools that aren't simply declare default and foreclose, but these opportunities to be able to have non-monetary potential default that give you a reason to sit down with your borrower, have a productive conversation, and head a problem off before it becomes acute and before you start to run out of options. So it's always good when you're looking at these situations, consider if you're going to be reworking the debt, what are some tools you would want to include? These could be additional financial covenants, greatly expanded financial reporting. It could be financial tests for the property, maybe inserting a DSCR requirement or an LTV requirement, allowing you to reappraise and check the value of your underlying asset. But in these types of situations where we're still facing a lot of uncertainty, where you're seeing, particularly in securitized lending, they've had a lot more defaults than historically what they would have predicted for this time period. And one thing I would just add here as we're getting close to the end, is I want to suggest that the government itself, the regulators who oversee our currency and our financial market, they are seeing the need to change their guidance, to update their guidance. And just about 2+ weeks ago, the Office of the Comptroller, the FDIC, and other related regulatory institutions reissued guidance for regulated lenders like banks and credit unions, giving them exact examples of real world situations where a loan was reworked early before it became a disaster for everybody, allowing the parties maybe go to a short-term interest only, extend the loan term, change maybe the payment requirement. And the guidance essentially said that if a lender is proactive and has a real workout strategy, they will not be criticized or downgraded for taking affirmative steps early. Well, I think that message from the government applies to any type of lender, regulated or private or otherwise, in that be bold, be willing to go out, engage with your borrowers, engage with your assets. So just to give you an idea of what I always think are best practices, having done this for a long time, is, again, look at your loan documents, find ways to engage with your borrowers, start discussion, get additional information. Don't hesitate to be creative. Don't hesitate to think about reworking terms, reworking time periods, so that you achieve an acceptable result for you that doesn't throw the entire loan into jeopardy. Go to your borrowers as soon as they give any indication of distress. Pay attention to the portfolios. Make sure that you include those types of business protections. So one thing that we have automated is what's known as the default letter / pre-negotiation letter. And that is really a very powerful tool, because if you do want to engage with your borrower in discussions, and if you want to talk to them very candidly and encourage them to do the same with you, this pre-negotiation letter sets up ground rules. The parties are allowed to talk. They're not bound by anything they may discuss while they're being honest and open with each other until they've actually reached a written agreement that they both have signed off on. And make sure that those documents contain the type of protections that we're talking about. So I would just encourage people to use these tools and start looking at situations now and be a little bold. Shore up your loan. Provide for them to be able to get to an exit strategy that will allow you to get paid off in full. And that may take a little bit of extra work, but it'll be worth it in the long run.
And Ren, I guess, irrespective of whether or not folks are using GoDocs, is your advice to be proactive rather than reactive in just about every situation?
Yeah, I would. And so, here we're looking at the kind of dramatic slide, but, whether it's automation or whether it's in attorneys, I would say that you're always well advised to be having these ongoing dialogues, being very honest with your customers, your borrowers, making sure that you set up these arrangements where you can have the type of quality conversation and don't just kind of think, let's just wait, maybe things will get better. In my experience, I've gone through a lot of downturns. I'm a good deal older than you, Andrew, unfortunately, but I've been through.
You're wiser. You're wiser.
Okay, I'll take that. But I've been through, the S&L crisis, the dot-com bubble, the global recession, and now this whole COVID and inflationary period. And I thought the inflation of my youth was not going to come back, at least not with any kind of force like it has the last 3 years. But what it's taught me is, in all of those circumstances, be aggressive, be proactive, because if you sit back and wait, they say in sport, I played a lot of sports growing up, and they said, People get injured when they go halfway. People get injured when they try to play it safe and not get too aggressive. And in fact, what happens is you get injured way more if you're holding back. Well, the same thing applies for a lender. If you're holding back and waiting, the chances that something might go sideways increase. I'm not saying it's always going to be horrible, but you certainly put yourself in a position where you may be left with few options.
Yeah. And again, just to kind of clarify the visual on this slide, the intent here is not to say that attorneys are not a valuable tool for you all. I think attorneys are an invaluable tool for everybody as we try to navigate what's happening in the market. But it's nice to have multiple arrows in your quiver, right? And so as you think about what this is going to feel like for your teams, as you try to work through all of these modifications at scale, and at a level of scale that I think most folks have not seen really any time, but certainly any time recently, it is helpful to have the ability to lean on some level of automation to support you and your teams as you go through this. So this is not to say that ModDocs or GoDocs fully replaces the need for attorneys, not the intent. The intent here is to say that this will make your lives easier in terms of being proactive and being creative and trying to get ahead of things by leveraging the automation that exists within GoDocs to get you started and to make sure that you're not overwhelmed by the amount of volume that's coming your way. Ren, anything you would add before we kind of jump into the Q&A around the need for speed, for lack of a better term, given what's happening in the market?
Yeah, I just think in my experience over the years that, again, the lenders who are looking out past the horizon, seeing maybe those wisps of smoke, what they want to do is they want to be able to act quickly and decisively. But to do that, it's very hard to do at scale if you're relying purely on human beings. I know that in my practice, as I was getting ready to retire, I was feeling more and more pressure because it was harder to keep the cost down. It was taking longer periods of time because we were almost essentially starting from scratch with templates, and having the ability to create a thorough, compliant, legally safe package very quickly gives that lender more ability to do small little bites at a time. What I mean by that is maybe you don't have to do a year extension. Maybe you could do 2 6-month extensions or 1 3-month extension, and then leave an option to add another potential 3-month extension. And if your cost is not prohibitive, and if your speed is such that you can make those decisions and move forward, it just improves your ability to stay 2 steps ahead of what's going on with your market, with your borrowers, with your real estate assets.
And is standardization helpful as well in this process? So as you look at all of the modifications you're doing, the ability to feel like a lot of the language, a lot of the documentation is relatively standard, as opposed to seeing kind of a mixed bag, or is that less critical here?
No, I think any time that you can have predictability, that you can have documents that you understand well, and that you know where the protections are, and you know where the push buttons are that allow you to have a healthy relationship with your borrower, there's a lot of standardization that goes on. What I would say, however, is that modifications are little mini loan renewals or new mini underwriting opportunities for lenders. And so also having capacity to have predictable, safe, legally compliant documents, but give you a lot of options to be creative and create a variety of tools to allow you to navigate the tough times. That combination is really, I think, essential. It's kind of the best of both worlds. You want very well understood, easy to use documents. At the same time, you do want to have options for complexity, for creativity.
Perfect. Thanks, Ren. I think it's time for the Q&A session. We've had some questions come in. I want to make sure I'm going through them. I think, we have a mix of existing customers and prospective customers on this webinar. So I've got a couple of questions about whether or not it looks different for them to start in terms of how quickly can they get up and running with modifications, and do the loans that they're modifying, do those have to have been originally created using GoDocs?
Yeah, thank you, Andrew. I think for me, what was very critical is that anybody, regardless if they had a set of documents generated by another DocGen program, generated by in-house lawyers or outside lawyers, that you would be able to take advantage of the full range of options that we have for the tools we've talked about today. So you can come in, and we do have a number of customers over the last year. One of the big driving points for them is they have portfolios that they need to do some work on, and they wanted to make sure that they could create as complete and comprehensive and thoughtful set of documents, regardless of whether it was a GoDocs set of documents previously or something that they had and that they needed to work through now. So you can come in, anybody can come in and essentially get working on mod docs with any type of document you may have, and the system will ask you the appropriate questions so that you get all of the correct and complete information in, and you can have a very tight package.
Perfect. Another question has come in, and I think we kind of addressed this in the previous conversation, but are we saying that they can fully replace the need for attorneys here, or is it really that we just provide the ability to have more of a hybrid approach and allow them to use some level of automation through GoDocs while still leveraging internal or outside counsel as needed?
Well, I will say, Andrew, with a lot of the things that we've expanded on with our Mod Docs platform, we do have a number of customers, particularly banking customers, who do a fairly high volume of what we call standard support modifications, assumptions, and et cetera, meaning they get almost instantaneous documents, they get all of the bells and whistles they want, and they don't need to go to outside counsel. On the other hand, I'm not, being a lawyer, I'm not in the game of wanting to put lawyers out of business. And so another tool that we have created is what we call LegalNet. And that is a network of attorneys who know our documents, get to know our customers. And if there are questions that are outside of what could be documented completely automatically, they're there with guaranteed turnaround times, very modest fixed fees for the tasks that they perform, and they're able to step in and provide that combination or that hybrid approach that very often may pose itself in a modification situation.
Perfect. So I guess of all the different kind of solutions that exist within Mod Docs, things we've talked about today, are there one or two you would point to say, these are absolutely key for lenders as they get started through the process of reworking maturing or distressed loans? Like where should most folks start? Kind of regardless again of using GoDocs or Mod Docs, where should most folks start with a lot of the loans that are coming due in the next year or two?
Well, I do think particularly if you've got a loan that's going to be maturing and you don't have a built-in extension, I think there are a couple of very simple things that probably everybody on this call are aware of, but it still is good to go over. One is get a new appraisal of the property, find out what your loan to value ratio, find out if the property is struggling, decreasing in value, or is holding its value pretty steadily. In addition, you'll also want to really go through and get updated financial information and not just maybe rely on the last time that you got financial reporting from your borrower and guarantors, but as for up to date, whether it's rent rolls for rental properties or financial statements from borrower, sponsors, and guarantors, make sure that you check that out. Number 3 is title protection. Get a prelim right away. See if any new liens have been put on the property. Find out if the borrower has played by the rules in the original loan document, and get on top of title early, because you'll want to work with title ultimately to make sure that if there have been some changes along the way, you're not only getting that lien priority protection, but any other endorsements that may be necessary because of new encroachments on the property, maybe new CC&Rs that you did not know had been imposed on the property. So I would say, Andrew, for me, those are kind of the very basic givens is valuation, updated financials, and making sure you understand the current condition of title for your property, and not just assuming, well, no news is good news, because very often it is not.
Got it. There a couple questions have come in around interest rates, which I will gloss over because I don't want to be on record having been incredibly wrong about what's going to happen to the market. Last question I have for you, Ren, is, what can people do to get ahead of the need to modify loans through their original loan documentation? What can they do to avoid the worst case scenarios as we start thinking about 2027, 2028, 2029 and beyond?
Yeah, like I said, that there are a lot of these non-monetary requirements and covenants and reps and warranties that your borrower made that are continuing in most good loan documents. They have these continuing covenants and reps and warranties, et cetera. I think I mentioned it earlier. Go back and take a look at your documents. Perhaps this is one of the great times to consult with counsel, whether it's in-house counsel or otherwise, and really thoughtfully look at what is there in my documents that I'd like to get more information on. And are there areas where if I start to see things slipping, that I can start an early conversation with my borrower, find out what their intent is, find out what their purpose is for this property. What is going to be their exit strategy? And use that by looking at what you currently have to help you then build the modifications and assumptions and other documentation that you'll need to carry you forward as you try to move into a situation where you can get repaid in full.
Perfect. Thank you, Red. We're coming up on time here. Hopefully everybody has found this to be helpful, informative, educational. If there is any interest in learning more about the Mod Docs offering, you're welcome to reach out to Ren or myself directly, or go to godocs.com and request a demo of the functionality. You can also, if you're an existing customer, reach out to your customer operations lead, and they will certainly put you in touch with Ren, who can provide you additional information and give you a quick demo on how this is going to work. But appreciate everybody's time today. Ren, I appreciate you co-piloting this webinar with me. Hopefully everyone's enjoyed the discussion. Hopefully you found this to be timely. And we look forward to speaking with many of you in the near future. Thank you so much.
Thanks, everybody.